want to be a great investor, but somehow sell at the wrong time or buy at the wrong time? Well, here to talk with me about that is Brian Regan from AMR Financial. Brian, welcome.
Hi, Bob. How you doing?
I'm doing great, and I'll be even greater after you walk us through an article you just wrote for us on Retirement Daily about this very topic. So I'm going to turn it over to you, Brian.
Yeah, so this article is inspired by, witnessing a lot of people get themselves into trouble. And I just wanted to write an outline or a guide to how to become a better investor. It's simple steps. It starts with the real emotional part of being a human being. And that is about addressing your needs, your wants. I was inspired by Morgan Housel's book, The Psychology of Money, where he talks about what's enough for you. And I think that, deciding on what's enough for you can really help you inform your risk tolerance. And once you have your risk tolerance, that's really the groundwork that you need to start becoming more logical. We call this article the inside out because the inside is what I'm talking about when you're an emotional being. And then as you address that, after you address that, you kind of need to leave that there and then start thinking logical. And the article progresses from, really easy ways to be logical to really difficult ways to be logical. And I think towards the end, what you realize is uh, many people jump to the hardest thing to do first rather than addressing, the emotional and then building out the basics. And I think the beauty of this guideline is you don't need to be an expert at all of them to be a pretty good investor. You really only need to figure out the first few steps. And if you really, want to excel, you figure out the last few steps.
So what's the next step as after you start with the inside? Is there a second step?
Yeah, so the inside's where you keep your family, your personal life, your religion, your politics, all that stuff. You leave it there after you address your risk preference, right? And then what you need to think about is we're all thinking for the long term. I write in the article that I've talked to 90-year-old people that have terminal diseases, and I'm telling them that they have a long-term time horizon, and they just laugh at me. They say, what are you talking about? Did you listen to anything I said about the disease I had? And the answer to them, to that comment is yes, but now you're investing for your heirs. You're investing for your philanthropic ventures. Endowments have time horizons that are infinite in theory. Same with charities. So many of us have longer time horizons than you think. If you're just entering retirement, hopefully you live for another 30, 40 years. That's not a short period of time. And if you're a younger investor, it should be fairly obvious that you should have a long time horizon. Now, this might seem obvious, but how many of us get caught up in the trap of thinking about the next 2 months, next 3 months? I've gotten the question recently, what do you think the market's going to do before the end of the year? That's only a 3-month time horizon. If you really want to set yourself up for success, you need to think in terms of decades. And if you're not thinking that way, you need to readdress the emotional part. Go back to step one.
As you're talking, Brian, I'm reminded of what Warren Buffett said at his most recent annual meeting, which was, throw away the daily newspapers and think about the long term because the short term will get you into trouble, right?
Yeah, that's interesting. I mean, I talked to a client this week. He said, I look at I look at the stock market every day, and this seems to be crazy. And I said, well, the first thing you should do is stop looking at it every day. Look at longer time return horizons, and you'll start to feel better about it. The next step, once you've accepted that you're going to be a long-term investor, it's about having the right asset allocation, the asset allocation that you can be comfortable with, right? Bob, we all know that we can invest in a money market fund today and get around 5%, right? Which is great. A lot of people are happy with that. Maybe, being a short-term bond investor right now is all you need. It fits your risk preference. You could stick with it for the long term, and that might fit your life. But if you're willing to take a little bit of risk, a little bit of volatility risk, if you're comfortable with that, we all know that you're likely going to get better returns over the longer term. And I wrote an article back in March of 2021 or 2022 when we were in the thick of the beginning of the downturn, the inflation-driven downturn. And I said, hey, look, this is going to get better, but it's going to take patience. And what we've seen is the stock market has outperformed cash or the money market fund by a good margin at that point. So what do we learn from this? Well, any mix of a volatile asset like the stock market and a non-volatile asset like the money market fund is going to provide you a decent return. And what you need to decide is what mix of that can I stick with the long term? Not what mix of that's going to give me the best return, because we all know that the stock market over time is probably going to be a better return than cash. But what can you stick with for the long term? Because if you can't stick with it, you're going to end up buying high and selling low. That's the reality of it. The next step is knowing. The next step is knowing your investments, right? We live in this beautiful world where you can buy just a money market fund and the index fund. They're easy to understand. And you can just do that. You'll have a nice diversified portfolio. You'll be able to, feel comfortable with your risk tolerance. But if you are a more ambitious person, you can go find, different kinds of investments. The key here is don't get caught in an investment that you don't understand. Don't buy an opaque company where you can't understand the business model, because when things go south or the price starts to go south, the chances of you sticking with that are much less. Or a more exaggerated example, which I wrote about in the article, is consider something like Enron. Enron was famously a spider web of entities that people didn't necessarily understand, with a business model that was not, as simple as the typical regulated utility that we have today, and people, had lost fortunes holding that stock. So, once you're a long-term investor, once you decide what kind of mix of investments you want, what kind of asset allocation you want, the key is making sure that you really understand those investments. And this all goes down to making sure that you can invest in the long term. I talked with a real estate investor not long ago, and he said, why shouldn't I just do real estate? I understand real estate. Why should I do stocks and bonds? And I said to him, I go, quite frankly, I would like you to be diversified. I think that's the best thing for you. But most importantly, you need to know the investment, be comfortable in the investment, and invest in it for the long term. And if you're more capable of doing that in real estate than in a more diversified portfolio, that might be the best thing for you. And that's something that you should consider.
Yeah. In the article, Brian, you talk about buying low and selling high. Talk a little bit about that.
Yeah, I mean, it seems like that's a simple idea, right? That's what we're all trying to do. But how do you know what's low and what's high? And that's the next step, right? You need to take the asset and decide on what a fair value is for that instrument, right? And if it's a stock, hopefully the company's growing, hopefully the company's progressing, and that value could go up over time. So you're not just constantly buying and selling. You can buy and hold and still hold an asset at fair value or below fair value for an extended period of time. But the only way to know that a stock is really overvalued and perhaps you should sell it is to understand the value of the company. In addition to that, you can be really picky, right? So every person in business school across the country is learning how to decide what the right discount rate is for their financial model. And what does that do? That gets you back to, the market return. An economist would tell you shouldn't expect anything more than the market return. Well, I'm more on the side of Warren Buffett, who says the market's a drunken psycho, and sometimes he gives you great opportunities. You can be euphoric or you can be depressed. And oftentimes, maybe not the whole market, but parts of the market can be depressed, and you should be looking out for those opportunities. And I believe that the economists are wrong, and that if you're a little picky, you could build a diversified portfolio. You're not going to have 1,000 stocks in the portfolio likely, but if you're paying attention and looking, you can build a diversified portfolio of stocks that you think are significantly undervalued and achieve a greater return on your investment. Now you can tell here, Bob, that we are getting very logical, right? At this point, we're talking about building financial models to determine intrinsic value. What I want to stress is you don't have to be able to do that. If you can, great. Like, you might be a really good investor, right? But if you have decided that you can invest for the long term, you have an asset allocation with investments that you understand, you're going to be way ahead of the crowd. You're just going to be way ahead of the crowd. Not only in my experience have I seen that, but I believe there's many studies that confirm that as well. Now, the final step is don't follow the crowd. Keep your cool. And when I mentioned at the beginning that I think people jump to the end, the hardest part, this is what I'm talking about, right? How often have we seen people jump into the hot stocks? How often have I been asked about, what do I think of, the stock that's most recently in the news that's going up. That's oftentimes the wrong way to think, right? I use an example of an oil and gas company, Chevron, in the article, where the best time to buy that was when oil was negative. The stock cratered along with oil. People on TV were often saying that it was uninvestable. Well, sure, this is with the benefit of hindsight, but we know this is a cyclical industry. We know it's a cyclical stock. We know that oil probably wasn't going to stay negative for forever. And that might be the type of contrarian thinking that could add some additional value to your portfolio. So, the message there is don't necessarily just jump in with the crowd. We all know that if you bought a meme stock at the top, you were down 80, 90% within a month. So, be careful, think about why you're buying, think about the value that you're buying. And this is, an additional level to the buy low, sell high, message that I was saying previously.
So I love this notion of inside out, Brian. Just one quick follow-up. You've mentioned individual stocks like Chevron and Enron, et cetera, et cetera. Many investors who may not have the time to investigate individual stocks might be better suited in ETFs or funds that offer broad diversification, or what's your thought on that?
I'm a big advocate for it, right? So again, you don't, as we get further out into the guide, we get more logical and more intense, and more study is necessary to do well. But like I said before, you don't need to do all the steps to be a good investor. If you just have a long-term time horizon, if you just know your investments, and you just get the right asset mix for you personally and for your emotional needs and your emotional intelligence, you're going to do very well. So a good way to know your investments is to buy broad market ETFs like the S&P 500. They don't cost anything. They're easy to understand. You're going to get exposure to the largest companies in the United States, and your biggest holdings are going to be your everyday names. That can be very, very attractive to most people. A money market fund, again, is extremely easy to understand. It's a lot of short-term borrowing from high-grade companies. You know that it's probably not, hopefully it's happened once, but it won't change the value of your principal, and you're going to collect some interest. I am a big proponent of keeping things simple. Not every, can be a very difficult business, and I'm not underneath the hood of my car, building a new engine, but I'll change my windshield wiper, and do what you can do.
So the other follow-up is we talked at the beginning about Morgan Housel's book, which I'm a big fan of. Had all my children read it, and I wonder, when you're talking about the emotional aspect of investing, oftentimes people there's at least recently in the past few years, decades, there's been a great deal of talk around behavioral finance, behavioral economics, and the notion that we have these cognitive and emotional biases. How smart do people need to know about things like recency bias or overconfidence, or et cetera, some of the biases that they may be affecting their investing?
The best thing you can do is know that you have them. I think it's most dangerous when people say, I don't fall prey to those things. I have a very sober mind. You have them. We all do. And it's about the extent that you have them and the steps that you take to address those biases. So I think everybody should be aware of them, and it's beneficial. But if you follow this guideline and this approach, you shouldn't have to worry about it, really, right? Because if you build an asset allocation with the volatility for your temperament, that you can stick with the long term, if you really actually do that, then you're going to be comfortable, and you're not going to fall prey to a lot of those biases.
Brian, this has been great. I want to thank you for sharing your knowledge and wisdom with our readers and viewers, and look forward to your future articles and videos.